So we have to do a portfolio update because I have not done one in 4 months. And no, it's not because it's been doing badly. In fact, it's been up every single month. So it's like a kind of missed opportunity for me to not do that. So that's how you know that I really don't care if this channel takes off or not. Because I'm not trying to sell courses. I'm not trying to like let everyone know that I'm the best investor ever, because I'm not. But what I am is just like a regular guy who like looks at things as they are, tries to evaluate them as best as I can to my ability and current knowledge. And I think I am better than the other people that do this. So how much better? I guess we'll find out in 50 years, you know? But right now it's doing well. If we look at the portfolio right now, we started with 40,000 in October. Our last update was on December 1st, where we were at 44 and a half, went all the way up to around like 47. In February, we went all the way around to 48. March 51, and then now we're at like 52. Absolutely incredible stuff. So if you are a new viewer, I do a buy and hold investing strategy, and I have a couple of different like portfolios out there. Birthday YOLO is my main one. Basic B is kind of like a joke one. Birthday Moderate is one I do for someone else who doesn't want to take as many risks as I do. And then lastly, we have the Boomer ETF, which is like Dave Ramsey's strategy, but without the fees in those ETFs. But one hot topic today is what happens if you invest before a crash? Because a lot of people think like a crash is looming. I've had people, both like normal people or like regular working people, tell me that a crash is coming. I've had people in small businesses tell me a crash is coming. I've had people in big businesses tell me that a crash is coming. Even people in like finance, they've been telling me a crash is coming too. But like they've been saying this for the past like couple years. So like when is it happening? Is it tomorrow? Is it like, look, we started at 40,000 like 5 months ago. Like we're at 52 now. So we're up like around like 30% on each portfolio. Like how did the S&P do? So let's look at VU with dividends reinvested from October until now. You'd be at 12,356 and 21 cents for an annualized return of 54.7. Obviously, annualized is going to be bigger, even though our dollar amounts are bigger here, because it hasn't even been a year yet in this portfolio. It's only been 5 months. So annualized, this gain is going to be much, much bigger. But let's just pretend you did S&P. You didn't listen to me. It's okay. It happens. People do that all the time. And well, again, like 50 years from now, we'll see who's correct, you know? But even if you did S&P 500, you're at 12.35.6. And oh no, let's say the market goes down like 20%, you're pretty much at where you started. It's like, is that the end of the world? No, it's not. And then it's like right after a crash. We're assuming that's like the lowest of the crash, right? Like, of course it could crash 40, but like that rarely happens. But even then, is it really that bad of a situation? Would you have rather had your cash in a checkings account? Like in hindsight, yeah, but at the time, probably not, right? Like you get eaten up by inflation. Like where else would you put your money? Like there are only so many places you could go to, like real estate, like crypto, NFTs, gold. Like there aren't many good options. So I just picked the one that I think is the most suitable one, at least for my taste. And yeah, like no matter what, you're going to get screwed by inflation. So you have to put it into something. So even if it crashes, like who cares? It's been 1 year. Maybe it takes like 2 years for the full crash to happen. So you're 3 years in, you're down a little bit, but like we live much longer than 3 years, right? Like I'm looking at the long term. I don't really care about any of that. Again, like we've been up the past like couple months, but I don't even care about that. Like I could have milked the videos, making an update video every month. Like, wow, I'm up. Wow, I'm up again. Wow, I'm up again. Wow, crazy, right? Like I really should have, right? But obviously life happened. I was busy with other things. So I just didn't care. I don't need to rely on YouTube to like make money, but we are still up happily. Like I'm not disappointed that I'm up, obviously, right? But let's go over the entire portfolio and then we'll end off with like a little story of what happens when you invest only at market peaks. And turns out, spoiler, it's not that bad, you know, but birthday YOLO, like doing the best so far. So in the last update, Basic B was like kicking everyone's tuckuses, but Birthday YOLO finally caught up because I think like Lululemon crashed recently, but even look at Lululemon, man. So we invested $600 approximately in it at the very start, and it's at 608 right now, but like it went up and then went down, and then there's like a big crash recently, but like you're still up a little bit, or like at worst even. So who cares, you know? Crashes can happen. Well, how big was this crash? It was 745 all the way down to like 600. That's going to be around like, yeah, minus 20%, 19%. You'll be fine. You'll be fine. We'll probably get back into Lululemon a bit later, but let's go to my main portfolio. So basically a birthday portfolio. If you start at around like 20, you pick around like 0 to 5 companies that you really like, or 0 to 10. It depends what your risk tolerance is. Pick more companies if you want to be a little less risky. But after that, every year that happens, you add one company and like you thoroughly research and vet all the companies that you buy. And then your portfolio becomes like nicely diversified throughout your lifetime. And it's also a buy and hold portfolio. So you want to be picking companies that you think will still be around by the time you're like 80, you know? So it's a little tricky. You're going to get some wrong. I'm going to get some wrong. But again, what else am I going to put my money in? The S&P 500 or things like that. Like they put their money in a lot of stupid things. Like IBM used to be a huge holding of the S&P 500, and like we all know how that went. And I don't want to be a part of that. So all right, let's start off with the first year that we had companies in. That's going to be Amazon, Meta, Google, and Disney. So Disney, I'm going to talk about a bit later in a different video because I've been reading Bob Iger's book, and it pretty much is a summary of everything he did before he rejoined Disney. And Bob Iger's the CEO of Disney, if you didn't know. And there's a lot of foreshadowing you could do based on his learnings from the book, which I'm actually a little pessimistic about. But Disney's such a powerful company. They have some room for error. A lot of people think like, oh, this company's has like some poison in it. They're gonna die. Like that does. It takes a lot to kill one of these companies, and I think they can rebound from it. They'll learn eventually. Like literally, all Disney has to do to make money is stop being stupid. Like it's very hard to do as one of these big companies because they like think they're above the world after a certain point, but literally all you have to do, and I'm not even trying to get too controversial or anything, but it's like just make good movies, like make fun theme parks, have nice programs on TV that people actually want to watch. That's literally all you have to do as a media company is make media that people want to consume. It's not that complicated, but apparently it is. Like I'm not the CEO of Disney. I trust Bob, you know. Big Bob has done incredibly well for Disney during his like previous tenures, but again, we'll get into more detail in that separate video. But Amazon is a little bit tricky, man. So they've been doing well since we bought them, and they've been doing well for like the past since they started. Like when have they not done well? There's this guy that told me like Amazon only knows how to go up, and it's held true throughout like all of my life. But just because that happened in the past doesn't mean it'll happen in the future, right? I actually think Amazon is in a bit of trouble. They don't treat their sellers very well, and I don't know if anyone's noticed, but when you go on Amazon now, it's no longer the Amazon of old. It's now just knockoff products that people go to a factory in China, they DM them, they're like, how much to buy 10,000 of these? And then they're like, 2 pennies. They're like, okay, they buy them, bring them to the US, slap their name brand on them. Or I guess they do that in China. They don't do that here. They tell the factory to like put their branding on it, and then they just sell those products at a markup here. And incredibly good business model, and Amazon definitely takes advantage of these people. And there's nothing wrong with that because they're not actually creating anything new, right? The issue comes when the majority of the Amazon marketplace now is a bunch of these like non-essential, non-branded products. And it kind of feels like, why would I buy stuff on Amazon when I could just go to AliExpress or Temu and just save some money? The only reason to buy something off of Amazon is because it arrives in 2 days instead of 2 months that it does on AliExpress. And something I ordered, I think it took like 6 months for it to get to me, but sometimes they're fast too. I've been surprised before. But there's going to be a lot of pressure from China in the future for Amazon. And I don't know how to navigate around that. I'm going to be honest. Like, I know the people at Amazon running Amazon are very smart people, but how involved is Jeff still? I've heard he doesn't do that much anymore, but I'm sure if he wants something done, like they will do it. Or if someone shits the bed, like he'll replace them, find someone better. Like he's not stupid, right? Like a lot of people think like, oh, these rich people are stupid. They're not stupid, you know, like they care a lot about their like legacy, brand name, whatever, and their money, of course. Like he's not going to let it die. Speaking of owner operated companies, like one of them is going to be Meta. Well, I guess Amazon isn't owner operator anymore, but like Jeff wants something, he'll get something. But okay, we have Mark Zuckerberg over here. Like one thing that impressed me recently in the past couple of months, because we haven't done an update in a while, is response to the Apple Vision Pro was absolutely well done. Great marketing, in my opinion. And I no longer think he's a lizard man, but he might be partially lizard man still. Like, who knows? Which product actually is better? It's tough to say. Like, I get dizzy. Like, I've tried the older MetaQuest or whatever it's called, and I got dizzy using it, so I was like, not for me. Not gonna really care too much about VR. Maybe in the future I will. Like that's why I'm hoping Apple's product is gonna be a lot better because they'll find some way to make it so that people like me will not get dizzy using it. I don't know how they're going to do that, but Apple's literally just that type of company. But we'll get more into that later. One thing to keep in mind, though, is that even though Meta's up recently, and even though I say the birthday portfolio is like a passive portfolio, but since you make money every month, ideally, right? Or you save money every month and you invest it. Timing of buys is going to be a bit different for this account versus my like real account or whatever you want to call it, where the bulk of my money is. In my like main account, like I've had made some like clutch buys because literally all Facebook has to do is stop wasting time in the metaverse and get into real life instead. And look what the metaverse did to them. They went from like $375 all the way to $90. Like that's absolutely insane. But I didn't buy at the absolute low. I bought definitely like throughout this whole time frame, but literally since then it went up all the way to 500. Absolutely insane stuff. But small gains like that aren't really going to be reflected too much in the M1 portfolio. So just keep that in mind whenever you're looking at this. This is just to like do like a general tracking, not like an exact track, you know? But overall, like the ending percentages of like what the breakdown of the entire portfolio is going to be pretty similar. Meta has like very big ambitions, which is probably what's fueling a lot of their stuff. They kind of get their hands everywhere. There are a lot of like software products that they make that like you and I wouldn't ever use or like think about, but other companies are like really into it. Not to mention that they compete with companies like Google over like internet ads and just a very solid company overall. But let's talk about Google. I don't really even want to talk about Google though. Like Google has dropped the bag so big on AI. If you think about it, ChatGPT is literally just powered by Google search. It's just like better Google search. And how did they drop the ball? It's absolutely incredible what they did. Incredible in a bad way. Like, how do you, as a company where everyone's using your information to like train on, like, you don't have a better product? Like, how embarrassing is that? How is the CEO allowed to be the CEO still? It's boggles my mind. Obviously, the solution is to just make a good AI product. Everyone will use it, I guarantee it. But they they have different goals involved. That's why when people are like, oh, like companies are so greedy, they only care about money. I say bullcrap because a lot of times you look at these management decisions and you're like, no, they're trying to like pursue something else. They're not purely profit driven. That's all I can say. And that's just from observing life, because literally all you have to do as Google is not be an idiot. Same with Disney, just don't be an idiot. Make a good product that people want to use, and they should be the king of AI, but instead they're not. Definitely a drop bag, but they're still profitable. They have a lot of other things that should be good. And honestly, if their whole business starts declining from today, you'll probably still make back your money if you own the entire company and didn't try to like save a sinking ship. So I think from like a value perspective, still a pretty decent buy because you have incredible upside if they just stop being stupid. And the downside, like, probably is like a break even if they do it correctly. I don't want to talk about Apple though. Like, I'm so tilted from Apple. Like, how do you not become the king of AI? Beyond me. All right, let's go to 2018. Apple's unironically down since we bought it. That's pretty funny, right? It went from like 1,000 to like 990. So since the S&P is up, this is pretty bad from Apple, but not the end of the world. Apple's facing a lot of lawsuits right now. Maybe they're releasing stupid products. I don't think they are, but like, honestly, who cares? Like, they make so much money, and we just talked about AI with Google, right? Like, AI could destroy Google, but AIs can't destroy Apple. People are always going to need physical products, and what's the company that makes the best physical products? Oh, it's Apple. Whether you agree with that or not, like, I really don't care because like they really do make the best products even if they're late on stuff. And the reason why they're late is because when you buy an Apple product, it like 100% functions as it is intended to. It's not like a 90% success rate. It's not a 95% success rate. It's like pretty much a 100, you know? That's why they're late to most things. And that's why they are worth, let's look at the market cap, $2.6 trillion. They were worth 3 trillion at one point, right? Like complete bonkers. But like, yeah, that's why they're worth so much, because anytime some tech product is going to be out there and you want one that all regular people like can use to like 90% effectiveness or whatever, Apple's going to be your guy. Like, yeah, you can't do like random customizations or whatever, but like most people don't care about that. Like a lot of these technology nerds or whatever, they're so disconnected from reality that they don't know what a normal person wants from one of their products. And there's also the argument of like, oh, their ecosystem's so good, whatever. Like, yeah, obviously that's a big thing too. But I think Apple's just smooth sailing for the most part. You don't need to worry too much about that, in my opinion. Hashtag not investing advice. But let's go down into the next one, which is going to be 2019. We have Goldman Sachs, Ulta, and Match Group. I want to talk about Match Group the most. It is down 5.5% since we bought it. Not since I bought it, but it's down even more since I bought it. I think since I bought it, it's down like 30% or something like that. It was up like 400% at one point, but then even from that 400% gain, they like went down to -30 from my initial purchase price. Like, so they went down like, I think like 10 times or something. Yeah, it used to be like 160. I bought it around like here. I forgot when. But yeah, now it's 35. I don't know how, because this company is like one of those stupid app companies, those mobile app companies that actually makes money. Very few of those companies do it. And if you look at Bumble, for example, first of all, like Match pretty much has a monopoly on dating apps. Apart from Bumble, they're worth around, let's see, like $9 billion, almost $10 billion. If we look at Bumble, Bumble does not actually make money. Like, yeah, their revenue's growing over here, which is like a fantastic sign, right? But like, they don't make money. It's probably on purpose that they don't make money. Maybe if they stopped trying to not make money, they would make money. But you have to keep in mind, like, Bumble's a much smaller company. They're valued right now at like 1.5 billion. Maybe you buy Bumble because they have the potential to turn into a Match, you know? It's hard though, because like Match literally just owns everything. But apparently Gen Z are using dating apps less compared to like other generations, or like what they would expect them to do, which is kind of surprising because I was always in the boat of, oh, people only stay inside now, they don't go outside anymore. I was actually having this argument with my dad. He made some bets that like people do want to go outside more, and I made some bets like this one where people don't want to go outside as much anymore. We'll see who's correct. Obviously, we have different time horizons, and who knows, we both could turn out to be correct, you know, just because stock go up in general, right? But we also have like different time horizons. He is what, like 40 years older than me, so if he's realistically looking at his like long-term outlook, it's like not that much more long-term, where I'm like looking at a 60-year outlook. He's looking at maybe like hopefully a 20. So we have like two different goals, right? I'm pretty sure I might be coping, but a company like Match, where they essentially can monetize off of like getting action or like love or whatever people use the apps for, it's one of the few opportunities where you could do it in like a semi-clean way, you know? And those don't come that often, in my opinion. Like, a lot of companies that do that are not allowed to go public, or they have like a lot of controversy around it. And these dating apps don't have that reputation for some reason. I don't know why. But if you look at the revenue over the years, like they're up during COVID, then like kind of still recovering after that. But I just don't see how it doesn't go up in the future, assuming they keep their like market presence. Like, some new app has to come out, but what can an app do? Do you know how hard it is to start a dating app? Try starting a dating app tomorrow. The marketing costs alone will like bankrupt most people trying to do this. Like, you cannot just be a solo dev, make your app, and like it goes viral overnight. Like, that's not going to happen with a dating app, because people are so used to using what's already out there, and they've tried most of the ideas already. Like, how much innovation is there that's left? I have one idea that I want to try, but I don't have a $10 million or like $100 million marketing budget for Instagram ads. So I don't know how my thing's going to work, you know? Maybe when I get to have 10 million to burn, how much money would I need to like just throw away 10 million on like a gamble, essentially? I'd probably need like $100 million. So even if I succeed on that gamble, no, more than that, I'd probably need like $200 million. So even if I succeed on the gamble, like, I don't need the money anymore. So this dating app idea that I have is actually completely useless to me in terms of like utility for my life, because once I can actually act on the opportunity, like, the money doesn't matter anymore. But essentially, it costs a lot of money to start a dating app, because you have no idea how many apps start and fail. The reason why is because it scales off of the more users you have. But how do you steal people from Tinder, from Hinge, things like that? It's very difficult to, because people are so used to it. Getting someone to just download your app in the first place, let alone replace an existing app on someone else's phone, is incredibly hard. And the way kids are raised nowadays, like, they don't have social skills. So like, how are they going to meet people? It's going to be through an app like this. Like, in my mind, it's clear as day. I don't care that the stock's down. In fact, maybe I should be buying more because of that. and probably diversifying into Bumble a bit too. Just do like a industry bet rather than like a company bet. Maybe I should do that in the future. Not to mention that they're like actually profitable. Like how rare is that a app on your phone is like actually profitable? Like look at this. Like they've only had down years during like 2016 or something like that. I always like buying companies that make a profit for obvious reasons, but obviously when you do that, you can't always get those like huge wins or whatever. So if you invest in Bumble, like they're worth 1/10 of Match right now, approximately, you have a lot more potential for like big gains in the future. And I'm not denying that, but you don't need to like be early on things to make money. Like Warren Buffett is late on everything, and he's made so much money in literally everything. It doesn't matter. Like he invested in Apple, I think in like 2015 was his first investment or something like that, 2016. Imagine investing in Apple in 2016 and 7 timesing your money up until today. That's what he did. And imagine if you got in earlier, yeah, you'd be like 100x, but who cares? Up 7x in like 7 years is an incredible feat. It's okay to be late, you could still make money. And that's why I don't like investing in companies that don't have a profit. There's only one company I really invested in that did not have a profit. It was Twitter. Made a ton of money there, don't get me wrong. Nothing crazy though, but overall, like fun times there. All right, let's go into the next company. What year are we at? Like 2020. All right, we had AMD. So, I mean, we're up 74% since we bought it. That's a lot of money. All right, like in 5 months, 75% essentially. Unfortunately, whenever people ask me if I bought Nvidia, I always tell them, nope, I lost the 50-50. I own a lot of AMD though. And everyone laughs at me as if it was so easy to predict that Nvidia would like skyrocket, right? Like if it was so easy, like why aren't they retired and I'm retired? Like that's what I say to them. Like, man, one guy said something that really tilted me. He was like, it's so obvious that Nvidia was going to go up. Why didn't you buy it? I was like, if I knew, I would have bought it. And in my mind, I was like, did you buy it? Like, I don't know if he did. Maybe I should ask him, but well, he doesn't have money to invest. But if it was easy, everyone would be quadrillionaires and then it wouldn't be special anymore, right? But the good news is that when the tide rises, all ships rise. You don't need to pick the winning horse every single time. You could pick the second place guy and still do fantastic. Like 75% since, like, come on, big gain right there. Like, I'm not sad about that at all. Am I jealous of Nvidia? Which, like, if we look at the yearly chart, they did like 225 versus 84%. Like, it hurts a little bit, you know? It's not that it doesn't hurt. When did we buy it? We bought it October 1st, so around here. Let's look at the 6-month chart, actually. Like, we're actually decently close on the 6-month chart. I guess we've been 6 months. I've been saying 5 months. That's my bad. Oh, in that time frame, we're not even outperformed that badly. But if you look at the 5-year, like, there's a pretty big difference. Or like the 1 year, pretty big difference. It's like triple the amount. It happens, you know? Like, I lose 50-50s all the time. And like, starting from, what is it? Like, that one's even worse, right? Like 82% versus 22%. But you can't say that something's so obvious and then like not be super rich. It's like when people say like, oh, why didn't you buy crypto? Like no one was buying it before. Like very few people actually did. So if it was so obvious, why is my friend who did invest in crypto still working and I'm not? Like that's all I'm gonna say there. All right, like so the reason why Nvidia is doing so well is because of AI, right? Like every company that wants to be active in AI are buying like a crap ton of video cards from Nvidia, and it makes sense, right? The reason why AMD not so special is because I'm not a developer. I don't proclaim to be an expert on AI or on coding or anything like that. In fact, like I don't claim to be an expert in a lot of things. But from my rudimentary understanding is that a lot of companies have built a lot of infrastructure on NVIDIA chips. And because of that, like you can't just switch over to AMD that easily. I think it's like people like using the NVIDIA, like, what's it called? Like libraries or packages or something like that. And apparently it's really hard to switch. So that's why they do a lot better than AMD. But AMD's got to be able to figure something out in the future, right? Like AI's just started. Well, it started maybe like a while ago, but there's a lot more room to grow. Like I've used a lot of AI products and like they could do better. They're pretty good right now. They're very usable for like 90% of things, but the last 10% matter a lot. You could also look at a lot of like duels in the past or like in history, and a lot of people think of like, oh, Microsoft versus Apple. They're around like tied now, right? But in the beginning, obviously for operating system, Windows kicked Apple's tuchus, right? And because of that, Apple found other ways to compete, and then they did the iPhone, and then like even like the Mac operating system, just because a lot of people don't buy it, it's because they can't afford it. They really want it, they just can't afford it, which is sad when I say it out loud, but It's just the truth, you know? Right, 2021, we're gonna look at Fox. Okay, so I actually sold Fox in my main portfolio. Maybe I should sell it here too. I made a mistake, you know, we're allowed to make mistakes. So I say I want to hold everything in my portfolio for the rest of my life, but the actual wording is I want to buy with the intention of holding for the rest of my life. And I think Fox is just a mistake because I went outside my circle of competence. People say to do that, you know, to stay within it. And I wanted to like I forced diversification. Like one of the things that I've learned through life is that you shouldn't force diversification, but I ended up making the mistake by buying Fox. So I really like media companies, and Fox just happened to be the most favorably valued. But it's just a declining industry. I thought I could like milk the last bits of it, but it may prove to be a little more tumultuous of a ride to do so. And I'd rather just have more in like my other companies. So that's why I sold off Fox. It's like just not needed for my purposes right now. So I might change my birthday investing rules. I'm not sure how much, but I feel like forcing yourself to like go into different territory is like not always the best idea. If anyone's watched Succession, like nothing against Rupert Murdoch's son or whatever, but like there's no way he's as good as Rupert Murdoch, right? You look at all father-son duos in like history, the really good one, their kid ends up not doing that well. There's a lot of cases where like someone who's like good or like mediocre, they give birth to like the greatest of all time or whatever. One example I could think of is Ken Griffey and Ken Griffey Jr. Ken Griffey was like solid, you know, like he wasn't a bad player by any means, but like Ken Griffey Jr. is like one of the best baseball players of all time. And I've never heard of the opposite happening where like Hank Aaron has a kid and then his kid turns out to be like the best baseball player ever. Like that story's a lot more difficult to find. I think it doesn't really happen. And that's essentially what's going to happen with Fox. It's like the son took over. Like it's literally the meme from Succession if anyone watches that show. Like there's no way that like he's going to be as like business savvy as his dad. There's a lot of things going like against this. Normally when I choose a company, I like having like a lot of indicators pointing in one direction or like a lot of indicators pointing in the wrong direction. I don't like just looking at one thing or focusing on like one aspect. I like having multiple things going for a company, and Fox just has a lot going like down for it. Even though I see some good, it's not enough to like justify not investing in like all the other companies I picked out, because for those companies, like there are a lot of signals going the good way, which obviously is preferred, right? Next up we have is Target and Berkshire Hathaway. So Target's very interesting. It's another one of those like timed buys that I had. I've been following Target for years, I think since I started, and I always wanted to add it to my portfolio, and it was like fairly priced. It was never egregiously overpriced or underpriced, but I just had other companies that I wanted to get into more often. And recently, let's look at the past 2 years, and there's like a drop for psychological reasons. I'm pretty sure people like way overreacted. But we bought around like here, or I bought around here and I bought around here. So I bought the first dip and then I bought the second dip. Normally it's like kind of risky to do that, but like they have such a loyal fan base, they're everywhere and they sell pretty much everything, right? And if we look at like their actual business, so if we look at like their annual report or whatever, like the numbers are pretty much the same as in previous years. Like, yeah, it's not growing, but like it doesn't need to grow that much. You could have a temporary setback. It's not gonna like kill the vibe or whatever. And if people are gonna sell this company because of some political nonsense, like some people attribute it to that. I don't know if that's the actual reason. There are a lot of reasons things drop, right? But like people attributed a lot to that. Like that's nonsense, right? Like the people who hate Target or like criticize Target for that stuff, like they never shopped at Target to begin with. So they're over at Walmart, you know? Like, so it doesn't really matter at all. So them like boycotting Target, like doesn't matter at all. I believe that people act in the best interest of their wallet, not so much their beliefs, because if you need to buy toilet paper and Target happens to be the most convenient place to do it for you, like you're gonna keep going there no matter what. Like come on, no one cares that much, you know? People do care. People do care that much, but I don't agree with that approach, you know? But whatever, you know, we made money. But the thing about Target is that I was happy buying pretty much throughout the entirety of the time I was looking at it. Like even when it was up here, like at the time it was fairly priced in my opinion. Same with all these other times here when I was like more seriously looking at it. Started around like 2022, 2023. I would have been happy buying there, but then a sale happened, like a flash sale happened. I was like, okay, sure. I bought it. No regrets, you know? It again goes with what I was saying before. Like when I have a lot of things pointing one way and I get like even more signals going that way, like then it's like, yeah, eventually I have to give in. All right, let's look at the other company, Berkshire Hathaway. Do I even need to talk about Berkshire Hathaway? I guess one thing is like rest in peace, Charlie Munger. I'm gonna read his book. A lot of people think that when Warren Buffett eventually does pass away, like the stock's gonna go down, but I really don't think so. Because if you look at like the core business, I forgot the guy's name. Like I really should know this, but the insurance guy, and that's like a major part of Berkshire Hathaway's. He essentially has been running the show for like so long already. Like you don't need Charlie Munger and Warren Buffett to do everything. And like all their lieutenants are highly, highly vetted. There's one guy that I want to talk about a little bit later in a future video. His name is Ted Weschler. I hope I'm pronouncing that correctly, but he essentially might be an even better investor than Warren Buffett. He has a IRA that's worth like hundreds of millions of dollars or something like that, and he started it with $70,000. Like he averaged, I think, like 30 some percent returns every single year for like 20 or 30 years. And that's essentially Warren Buffett level. But that's like the people who are replacing Warren Buffett eventually. It's like you're gonna be in good hands. So I think what Warren Buffett's actually gonna think when he does pass away, his spirit's gonna go out of his body, and then like he's gonna see from his ghost is gonna see like the price drop, and then he'll be chuckling because he'll be like, man, it's like a free sale. Like sales for fun. Like we did that for Target. When he passes away, I hope I outlive Warren Buffett because I'm like 60 years younger than him. When that happens and it drops, like I'm gonna be buying no matter what. Almost like I hope he lives much longer because like I really respect the guy. He'll probably look back and be like, yeah, that's like a great time to like buy Berkshire Hathaway. That's what I'm gonna guess, at least when his spirit leaves his body or whatever. But maybe I'm getting influenced by the price a little bit by like what I'm saying. Like, but in all seriousness, and it's literally just like a couple cents off from like the magic number. The overall like Berkshire portfolio is like in very good hands, and they also only own companies that actually do productive things. So there's we don't need to talk about Berkshire Hathaway. Like there's enough information out there on that. But that is a portfolio update. We're 6 months in and we're up like 33%. That's incredible stuff. By the way, like I don't add additional money to the account ever. I know it says net cash flows of like 40,506. You might be wondering where the 506 comes from. I believe like some of it comes from the dividend, and then I also had like the sign up bonus. That's why it's not 40,000 flat, but I'm not going to add actual money to the account anymore. Like obviously if people sign up through my referral link and I get a referral bonus, like it'll show up there, but like we're mainly just looking at it from like the 40,000 perspective, because I'm not just going to like add money to make it look bigger for fun, you know? That'd be pretty cheap. But let's look at the other portfolios. Like they're all up a little bit. Basic B, absolutely hilarious. In good economic times, like this portfolio should do incredibly, incredibly, incredibly well because it's literally just like all consumer luxury-esque products. But maybe we're approaching bad times now. Maybe it doesn't do as well. It's gonna be tough. It's gonna be tough. Like I already know like Chipotle, they're up apparently 58% since this started. Holy cow. But like, I don't want to eat at Chipotle anymore. Like, let's start a Chipotle boycott because a chicken bowl around me costs like $15 after tax. Like, it's a rice bowl. Why am I get absolute bonker stuff? Maybe that's just how much things are going to end up costing now. Like, thank you, inflation, you know? But literally, I never bought guac at Chipotle, even though I love their guac. And it's because like not that I can't afford it, but like I don't want to pay like $2.50 or whatever it is for like a small little cup of guac, you know? And now it's like approaching the range where I can't even justify buying the chicken bowl, and I like the steak bowl the most. So hopefully Chipotle's cheaper around where you guys are, but it sucks because I actually do like the food at Chipotle. It's kind of depressing. But yeah, just keep in mind like the gain percentages aren't always going to be super accurate because like the way they rebalance the portfolio, I wish there was a way to like individually rebalance, because it's putting all the dividend money into like the worst performing fund, which is going to be the Boomer ETF fund. You can see that by like the net cash flow being highest here, whereas the other ones are like 10,000 flat, almost like 9999999. So maybe there's a way to fix that. Does anyone know how to like actually use M1 Finance? Because I don't use this for my main portfolio. I just use it as like a to showcase what it does because it has like the pie thing. But I wish there was a way to like rebalance within a portfolio instead of outside of it. That'd be kind of cool, because if not, it's just going to get skewed and then this one's going to look better than it actually is. I literally made this so that we wouldn't have to deal with that nonsense, and I wish there was a way to reinvest into itself. Maybe there's a way to do that. I'll look into it later. And that we only have like 6 months messed up, which isn't the end of the world, you know? But let's get back into the story of like the investing in crashes, which is what we started off this video with. Like everyone's been telling me my entire life, every single year, no matter what month, like a crash is coming. And even if it happens, you're not going to be that badly affected because there's a story of the worst investor of all time, like hypothetically speaking, of course. And it talks about a guy that only invested at market peaks. So the gist of it is you start investing in 1970 at age of 22. You save 2,000 every year during that decade, then you increase it by 2,000 every other decade. So the next decade you save 4,000, after that 6,000, after that 8,000. And you also only invest in market peaks. So pretty much you get your money, put it in your bank account, and you let it sit there until the market's at a top. You buy at the top, and then it drops right after, and then you wait until the next peak, and then buy again, and it drops. And the way it works out is that after all said and done, this person invested $184,000 throughout his like fake career, and he ends up having 1.1 million investing at market peaks. That is absolutely wild. So imagine if you're not a complete dumbass and invested at like random times throughout your life and not purposely doing it during the peaks, you're going to be making much more than what this guy made. And it just goes to show the power of like long-term outlook and power of compounding. I've actually been like listening to this audiobook. It's called Same as Ever. They talk about like, oh, it's like easy to talk about the long term, which is essentially what I'm doing, right? It's much harder to execute, but it's literally all you have to do. Like literally just like buy, hold, like push it away. You know, I guess if it's in your like 401k or whatever, it's like really hard to touch anyways. So as long as you keep putting like some amount of money there, like you're gonna be fine. I know people that are putting in like much more than what this guy saved. Like I save much more than what this guy saves every year. But imagine if you just did like any of that, you'll be fine by the time you retire. Obviously, my channel is about like retiring a bit earlier, so you have to save much more aggressively than this guy. And you also have to not be unlucky like this person. Well, this guy's a bit stupid and unlucky, but you can see how it's possible, right? Like I'm not crazy. Maybe I am a little bit, but like just because I'm crazy doesn't mean like stuff doesn't make sense. But yeah, looking at the overall portfolio, we're just like up huge, up 30% overall. Like very happy about that. Could be more, could be less, and we're outperforming the S&P 500. So that's another good plus. I have this one friend, he always criticizes me whenever I like talk about anything related to stocks, and he's always like, what would happen instead if you invested in S&P 500 instead of doing your stupid strategies or whatever? I'm like, I'm up above that, you know, like I don't know what to tell him, but he's always doubtful of a lot of things. So all good, you know, it's just who he is. But I always do compare to the S&P 500 because again, I like using it as like a soft benchmark to like see how I'm doing or if I'm just like wasting my time, because there are some people who do what I do and they would have been better off doing something else. But like I have this egotistical belief that I am better than other people, so unfortunate, but there's a lot of evidence that I saw that made me come to that conclusion, so I have that going for me. I believe one thing I always do say is that there's like different tiers of advice for different type of people. Like if you aren't confident in this stuff and like, or you know you're not good at this, like doctors are notorious for this. Doctors are incredibly smart people and hardworking people, but for some reason, like there's a stereotype that they're like the worst investors, and it's because they like think they're so smart, which they are in their field, but it's like a different field. So you have to like know which fields you're good at. And if you are good at it, like definitely go the extra mile in it. Don't like do the noob strategy or whatever, right? But if you're like completely foreign to something, then yeah, do the noob strategy. Just like do S&P 500, call it a day, you know? So different strokes for different folks, but hopefully even if you are one of those people who want to do the like easier strategy, like maybe my adventure's fun to you to like hear about as well. So that could be cool too. But yeah, any M1 finance experts know how to like make the pies reinvest into themselves individually instead of like rebalancing to the crappy portfolio. Like I don't want to look at this like 20 years from now and then the Dave Ramsey portfolio is like actually more money, but it's only because like all the stupid dividends went into here instead of like the good portfolio. What do they call this? I think Warren Buffett says it's like cutting the flowers and watering the weeds. I don't want to do that, you know, like I just want to keep this like general breakdown of what we set out in the beginning and go from there. But yeah, that's gonna be it from me today. I'm gonna be coming out with more videos again. Like I know I haven't posted in so long, it's because like stuff happened in life, but hopefully I'll just push through and keep making good stuff. I got some pretty funny ones for later this week, so definitely keep a lookout for that. Also, like Let me know. Do we need to do a portfolio update every month? It's a passive investing strategy. Like, I could talk about the news or whatever, but like, it's not going to change my actions. So, like, I don't know. Maybe we do this once a quarter. Maybe we do it once every 10 years, you know? Let me know your thoughts. Like, obviously, it's interesting to hear what's happening at each of these companies, but there's a lot that happens, and I don't like scour the news every single day for like everything that's happening because I'm not going to act on it. So, it's like a waste of time in a lot of cases. But let me know your thoughts on that too, because I don't know how often people want this to actually be updated. But that's going to be it for me today. Hope to see you all next time.